approach, ditching traditional models and assumptions. What immediately strikes you as interesting or potentially problematic about this approach from a practical perspective?
The most intriguing aspect is the potential for bypassing the limitations of classical option pricing models like Black-Scholes. These models rely on strong assumptions about market efficiency and predictable dynamics, which often don't hold in reality. A data-driven approach could capture nonlinear relationships and market nuances that traditional models miss. However, the potential problem is the risk of overfitting to historical data, especially given the complexity of options markets and the potential for regime shifts. Robustness and generalization to unseen market conditions are crucial concerns.
Exactly. Overfitting is a major concern with deep learning. How did the authors address this, and what metrics did they use to evaluate the model's performance beyond just raw profitability?
They employed an expanding window approach for backtesting, training on progressively larger datasets, and evaluating out-of-sample performance. This helps to assess the model's ability to generalize. Furthermore, they didn't just focus on raw returns. They used risk-adjusted metrics like the Sharpe ratio, Sortino ratio, and Kalmar ratio to evaluate performance, which is crucial in options trading where risk management is paramount.
Good point. Risk-adjusted metrics are essential. What kind of deep learning architectures did they explore, and why did they choose those specific ones?
They experimented with several architectures: linear models, multi-layer perceptrons, MLPs, convolutional neural networks, CNNs, and long short-term memory, LSTMs. The choice reflects a desire to explore the effectiveness of different approaches to capturing temporal dependencies and nonlinear relationships in the data. LSTMs, for example, are well suited for sequential data, like time series of option prices.
And what about the data itself? What kind of data did they use, and were there any significant data pre-processing steps?
They used option contract data from option metrics, including bid-ask prices, implied volatility, and Greeks. They focused on S&P 100 index options, ensuring sufficient liquidity. Pre-processing involved filtering out options with problematic price observations, ensuring data consistency, and focusing on standard monthly contracts. They also formed delta-neutral straddle portfolios to mitigate directional risk.
Delta-neutral strategies are common in options trading. How did their deep learning models compare to established rules-based strategies?
The deep learning models, particularly the LSTM, significantly outperformed the rules-based benchmarks in terms of risk-adjusted returns, especially the Sharpe ratio. This suggests that the deep learning approach can effectively capture complex patterns in the data that rules-based systems miss.
That's a significant finding. But how robust are these results to transaction costs, a major factor in high-frequency trading?
That's a critical point. They analyzed the impact of transaction costs and found that the LSTM's advantage persisted up to a certain level of transaction costs. To further improve robustness, they incorporated turnover regularization into the training process, enhancing performance at even higher transaction cost levels.
Turnover regularization is a clever approach. Can you elaborate on how that works and why it's beneficial?
Turnover regularization penalizes frequent trading, encouraging the model to make fewer trades and reduce transaction costs. This is achieved by modifying the loss function to include a term that penalizes high turnover. It's beneficial because it helps to balance the trade-off between maximizing returns and minimizing transaction costs.
So the model learns to be more selective in its trades. What were the key features used as input to the models?
The input features included normalized returns at various timescales, mass CD indicators, option momentum features based on past returns, and core option features like log moneyness and days to expiry. Importantly, they avoided using implied volatility or Greeks, avoiding reliance on specific option pricing models.
The avoidance of model-specific features is a strength. What are the broader implications of this research?
The study demonstrates the potential of deep learning for developing sophisticated, data-driven options trading strategies. The end-to-end approach offers flexibility and adaptability, potentially applicable to other derivative instruments. However, ongoing monitoring and adaptation are crucial due to the ever-changing nature of financial markets.
Absolutely. The dynamic nature of markets is a key challenge. What are some limitations of this study, and what future research directions do you see?
One limitation is the reliance on historical data, which may not perfectly reflect future market behavior. Future research could explore incorporating alternative data sources, such as news sentiment or social media data, to enhance predictive power. Also, exploring more advanced deep learning architectures and techniques could further improve performance.
Incorporating alternative data is a promising avenue. Did they consider any specific types of options beyond straddles?
No, this study focused specifically on delta-neutral straddles. Future work could extend the analysis to other option strategies, such as spreads or strangles, to see if the deep learning approach generalizes well.
Expanding to other option strategies would be valuable. What about the computational resources required for this type of research?
The authors acknowledge the need for significant computational resources, using a server with multiple GPUs for model training. This highlights the computational intensity of deep learning for finance, which is a barrier to entry for some researchers.
That's a good point to end on. The computational demands are significant, but the potential rewards are equally substantial. Thank you for this discussion.